This is the final exam review for Accounting 5210, Spring 2016. So what I'm going to do with this is I will go over the topics that will be covered on the final exam, and then we'll go over the review assignment that you completed for class. Before we start that, though, I want to just give you a reminder that there is 5210 assessment, which is for accreditation on Canvas. And so don't forget to take this assessment. This will close on May 6th, which is Friday at 8 p.m. So your motivation to take this is you get 10 extra points if you get 8 or more questions correct. And if you get 7 or less, then you still get 5 points. So there's a total of 17 multiple choice questions. Again, you have 90 minutes to do it, which I hope is plenty of time to complete those 17 questions. So don't forget to take that. It's important for our department in terms of staying accredited. All right, so for the final exam, here's the topics. Again, I don't think any of these will be a surprise to you. You can see that the two main topics that we covered since the second midterm is capital budgeting and inventory management. So in capital budgeting, it's basically everything that we've talked about. Conceptually, we talked about where does capital budgeting fit in the overall budgeting process. We do capital budgeting to understand what types of resources are going to be needed to acquire long-term assets. And so if the capital budgeting flows into the cash budget and our cash requirements for acquiring those assets. So you do need to be able to compute the relevant cash flows, starting with the net initial investment and all of the cash flows throughout the project, and then the cash flows from sale of assets either at the beginning or the end of the project. And remembering that all of these cash flows have to be after tax, because tax is a relevant cash outflow or cash inflow if it's tax savings. And then be able to calculate all of the capital budgeting metrics that we did in class and for the project that you completed. And so you'll have to do these by hand, so please remember to bring your financial calculator so you'll be able to discount, especially in relation to the net present value and the internal rate of return. So you'll have to do those by hand, those calculations by hand. And if you want a reference for the type of problem that might be on the exam, you can look at Left Company. Again, you'll have to go all the way from net initial investment all the way through to calculating these metrics for a problem. Then for inventory management, all the stuff that we covered here is understanding what costs we have, or what costs we incur when we actually have inventory, and then using the economic order quantity model, which is a simplified model which focuses on carrying and ordering costs and minimizing the total of those two. So being able to calculate economic order quantity, being able to determine by looking at our inventory levels when to reorder, so determining the reorder point, and determining and calculating the amount of safety stock that we might hold for cases where our lead time may be different than we expected, or our sales rate or usage rate might be different than expected, then being able to determine the cost of a prediction error for any of the parameters that we have in our economic order quantity model. Then the comprehensive stuff, let me just put all this up here. And so you can see see here that you have most of the topics that were covered in the review assignment also on this screen. So, and I also tell you exactly where these topics may show up on the exam. So, for example, if you look at job order costing, this says that you'll have a short and a long problem on job order costing. And so we'll go through some problems here in the review assignment, but know how to calculate cost of goods manufactured, cost of goods sold, ending work in process, including here, I don't have it specifically written down here, but you should be able to determine whether overhead is over or under applied also. Activity-based costing, you'll see a multiple choice question on that. Process costing, I'm pulling a lot forward into this exam from process costing, so you'll see multiple choice, short problem, long problem. And so you will need to know how to do equivalent units, both FIFO and weighted average, knowing how to treat, in that sense, knowing how to treat transferred in units and knowing how to treat spoilage is included in that, and then being able to assign cost to units transferred out, determining that cost of goods manufactured and the cost of ending work in process and the cost of spoilage. Normal spoilage is included in cost of goods manufactured. Abnormal spoilage we write off to the income statement in the period that we actually identify it. Then variances, you have your multiple choice question and a short problem. Variances, I think I've mentioned before in class that you will see a backwards variance problem similar to what you saw on the second midterm, and then also the calculation of a volume variance. So be aware that those are possibilities. Then cost volume profit, possible multiple choice question. So cost volume profit, you will not have any multiple product cost volume profit, and you will not have any journal entries on this exam, even though they're important. Just not enough time to cover those, but be aware that journal entries are part of your part of being an accountant, so just be aware that journal entries will follow you forever. Alright, so here's the front page of the exam. You can see that you have 10 multiple choice questions, but the short problems I've actually changed, and I didn't update my slides, so you have only 5 short problems and then 4 longer problems. The 4 longer problems, you can see that I did promise you that one of these problems would be your capital budgeting problem, and this is this problem. So this is capital budgeting, and the other 3 problems, one of those problems is related to process costing, one of those problems are related to inventory management, and one of those problems is related to job order costing. So you have a couple of those that come from material that we've covered before, and then capital budgeting and inventory management. Now, included in your short problems from the prior slide, you will have the variances to deal with, and job order costing is one of the short problems also. And let's see, I think I remember the other ones. Variances, job order costing from the comprehensive stuff, and process costing. Alright, so that should give you some guidance as to what you'll find in there. Alright, so let's go through the review assignment, and we're just going to start with number 1 and go all the way through. And so in this question, this is a cash collection problem. So in this problem, one of the tricky parts is you have this 2% cash discount. And so what that means, if the customers pay for the sales in the month they actually buy the merchandise, then 30% of those customers will pay in the same month. So, for example, in December I have $60,000 worth of sales. 30% of my customers will pay, or I'll collect 30% of that, and of that 30%, if they pay in December, then I will give them a 2% discount. So actually, we're only getting 98% of what we collect in the month of sale. So here's our collection. So again, you can see in December that what we have is, this represents that cash discount, and so in December we collect 30% of the $60,000, but with that cash discount it only ends up being 98% of the 30% of the $60,000, and then you see November sales is 50% and October sales 15%, and that follows our cash collection schedule we have up here in the problem. Alright, number 2. Number 2 is trying to determine what the cash effects are of selling an asset. And this is important for determining, especially in capital budgeting, determining the net initial investment, because we have to identify the cash effects of that separately. And so this company has an asset that they originally paid $170,000, and they have 109,000 of accumulated depreciation, and they're going to sell it for 50,000. So we want to know, what is the after-tax cash inflow from the sale? Well, obviously we're going to get $50,000 in cash, but what we also have to determine is whether or not we have a gain or loss, and the tax effects of that gain or loss. We'll pay taxes if we have a gain. We'll have tax savings if we have a loss. So the gain or loss, we have the 50,000 in proceeds based on the original cost and the accumulated depreciation. We have a book value of 61,000. So that means that we have a loss of 11,000. And so that loss of 11,000 is going to produce tax savings. And remember, our assumption has been, and it will continue to be, that if we have a loss on the sale, or if we have negative before tax income, or negative or before tax loss, I guess, then we are going to assume that we have positive income somewhere else where we can actually take the savings or benefit from the savings in the same year that we have before tax loss or a loss on the sale. And so you can see that our tax savings, we save 40 cents for every dollar in loss that we have. So our total tax savings from that loss is 4,400. So we add that to the 50,000. So essentially what we have is a tax or a cash inflow of 54,400. Problem number three. Problem number three is process costing, and so what we're looking at here, we're trying to determine the equivalent units for materials. And so we know that we have beginning work in process of 10,000 gallons, and the conversion process is 40% complete. And so during January, we start 100,000 gallons, and we end up with 15,000 gallons in ending inventory. So if you look at the cost flow, or the physical flow, the physical flow here, we have 10,000 units, 100,000 started, and so we have to count for 110,000 units. And so we know that 15,000 of those units end up in ending work in process, which means that 95,000 of those units are transferred out. Now, if you think about the 95,000 that were transferred out, 10,000 of those came from beginning work in process, so we actually have 85,000 units started and completed. So now you have to think about our materials, because we're trying to determine the equivalent units for materials. And so we know that materials are added when the units are 50% complete. And so what this means is, as I do my conversion and I get to that 50% in my conversion process, I will add all of my materials. And so what I have to look at is where I'm at in the conversion process, both for my beginning and ending inventory. So if you look at the beginning inventory, those 10,000 units or 10,000 gallons are 40% complete, which means coming into this period, coming into January, I'm already only 40% through the conversion process. So if you think about materials are added at the 50%, when those units are 50% complete, since I'm only at the 40% mark, then those materials have not been added as of the beginning of January. So if I'm doing the FIFO method here, and for materials, then those 10,000 gallons in beginning work in process, I have not added the materials to those 10,000 gallons in my process at the beginning of January. So during January, I will add all my materials, because it is in January I will reach the 50% completion point. And so if you look at the equivalent units then, and I have conversion here too, so you can double check yourself on calculating equivalent units for conversion. And so for materials, again, you look at this, the materials in beginning work in process. Since I have not reached the 50% conversion point as of the beginning of the month, I will reach that during January. All of my materials are added in January. Then those 85,000 units started and completed. By definition, all the materials and all the conversion have been added to those units. Then I think about ending work in process. Ending work in process is 70% complete. So I converted those 15,000 gallons 70% through my process, which means I've passed the 50% mark. And so those 15,000 gallons, all of the materials in my department have been added this period. So the ending work in process, all of the materials are added to those 15,000 gallons, so I include 100% of those, and then 70% for conversion. So the answer to this question, the equivalent units for materials, is a total of 110,000. Now again, what you're looking at is you're looking at the percent complete in this type of a problem where you know you have the materials added at a certain point in the process. You're looking at where are you at in the process for your beginning inventory and where are you at in the process in your ending inventory. Now how does this change if I were to do weighted average? Now I know the difference between FIFO and weighted average is how I treat the units in beginning work in process, and so for weighted average I include all of the materials and all of the work that I've done on those units. So I include everything that I did maybe in December and January. So really conceptually, those beginning work in process units are included 100% in my equivalent unit calculation under weighted average, and then everything else is the same. It doesn't change. Again, the only difference between FIFO and weighted average is how I treat those units in beginning work in process. All right, number 4. Number 4 is the cost volume profit. Given information, you know that variable costs are $150,000 when sales are $200,000, and fixed costs total $30,000. So really, on these type of problems, cost volume profit, you're just looking at the operating income equation. If you look at what you have here, you need to determine at what point, what sales level is going to give me an operating income of 0. So if I do 200,000 minus the 150,000 minus 30,000, I know that does not equal 0, and so this is not break even. And if I do this, then I actually get an operating income of 20,000. So what I have to do is I have to figure out what level of sales, what level of variable cost minus 30,000 is going to give me an operating income of 0. So I really have to work with the fact that I know that variable costs change when sales change, and I can find the ratio of variable cost to sales and either use the variable cost ratio or the contribution margin ratio to determine what break even is. So my percentage of variable cost to total sales is 75%, and again you could use 25% as the contribution margin ratio. Again, that would show up here. So basically what you have here is 0.25x minus 30,000 is equal to 0. And so if you solve that, then the sales level that gives you break even is 120,000. All right, this problem, actually this relates to problems 5, 6, 7, and that's all, 5, 6, and 7. And so this is a capital budgeting problem, which I only ask you 3 questions, but you could take this problem all the way through from the beginning to the end and calculate those 4 capital budgeting metrics, and I'll give you the answers to the ones I didn't ask. But anyway, you have this situation where a company is looking to buy a new machine. The new machine costs $650,000, but if they buy the new machine, they're going to get rid of an old machine. The old machine can be sold for $90,000. It doesn't have any book value in this case, so you have a total gain of $90,000. They use straight line depreciation for tax purposes, which is acceptable, but we still have to apply the half-year convention. The machine has a 5-year life, and we're going to invest $20,000 in working capital, $60,000 in cash for the first year, $240,000 for each additional year of use. So here's the part where you really have to pay attention, because I have a 5-year, I'm expecting to use this machine for 5 years, and so it doesn't say that we're going to sell the machine that costs $650,000. So here, if I'm using the half-year convention, and I'm not selling it at the end of the time that I use it, it has a 5-year useful life, and I'm going to use it for 5 years. These cash flows, I'll get this one in the first year, and I'll get 4 years of the $240,000. But I will have cash flows for 6 years because of this half-year convention. I take a half-year depreciation in the first year and a half-year depreciation in the very last year. Because I don't sell this equipment, then I have 6 years of cash flows, that last year being a cash flow based on tax savings I'm going to get from depreciation. All right, so let's go through the questions that were asked on this. And so number 5 is the net initial investment. So the net initial investment includes the cost of the machine, the working capital that I'm going to invest, the proceeds from the sale of any assets that I now hold, and the tax effect of that sale. And so if you look at what we have, you see the $650,000, the $20,000. I sell the existing machine for a total of $90,000. Since the book value here is 0, so this is minus 0 book value, so that the total gain is $90,000. I multiply that times the tax rate and I get a total tax of $27,000, and my total net initial investment is $607,000. Now notice your book value is not always going to be 0, so be very careful about determining that gain or loss, because the gain or loss is based on the gain or loss, or the tax is based on the gain or loss, not the proceeds. Alright, so what is the accounting rate of return for this investment? And so the accounting rate of return is equal to the average after-tax net income divided by that net initial investment. And so what you have to find is the average after-tax net income. This is not your tax flows. So if you go through and calculate this, you can see I have 6 years up here. And so you see that you have your half year of depreciation in the first year, your half year of depreciation in the 6th year. Because I don't sell the asset at the end of its useful life, I get to take that depreciation deduction in that final 6th year. And so my after-tax net income, my average after-tax net income, what you're looking at here is you're taking this row right here. You're averaging the after-tax net income, not the cash flows. So if I average that, what I end up getting is my average after-tax net income is equal to $43,167. And so my accounting rate of return is that $43,167 divided by the $607,000 net initial investment, and you get 7.11%. Alright, and then the net present value. The net present value now is taking the present value of the after-tax cash flows. So you take the present value of these cash flows minus the net initial investment, and that's your net present value. And so this is where your financial calculator is going to come in handy. You're going to put in your cash flows, and your initial cash flows, your net initial investment, putting that in typically as a negative, and everything else in as a positive, as long as it's a positive cash flow. And so what you should get for net present value is $19,157. And be sure to practice this, because it's not something you want to try to learn how to do on your calculator during the exam. Alright, since we have the information, you should be able to calculate internal rate of return, which again is simple if you have put the cash flows in your calculator. So just double check that you can get to an internal rate of return of 13.1%. Then you also should be able to calculate the payback. The payback is based on the cash flows. So what you're looking at is you're taking these cash flows and comparing it to your initial investment of $607,000 and determining at what point do you actually get or recover that $607,000. So you're just going year by year and determining what year you're actually going to recover that. And it turns out you're going to recover your investment in year 4. And so you should be able to calculate your payback at 3.64 years. Alright, number 8. Number 8 is, again, inventory management, but you're just working a little backwards here to get one of the missing parameters. And so you know what your economic order quantity is, so you've used this equation, and what this is giving you is you have all of this information. So you know what this economic order quantity is. So the economic order quantity is 200. And so really all you're doing is solving for the missing parameter, you know that this is 2 times demand, which is 5,000, times your order cost, which is $8, divided by C. So if you solve that for C, scoring both sides gives you 40,000 is equal to 80,000 over C, then C is equal to $2. All right, and so the next few questions here, 9, 10, 11, and actually 12 is based on this information. And so again, this is inventory management. You have a situation where a company purchases these DVDs and they pay $10 per DVD, but they're shipped in packages of 25. So every package has 25 DVDs. The annual demand is 208,000 DVDs, but in terms of packages, I take the 208,000 divided by 25, and my demand is actually 8,320, which we'll use here in a second. We sell them at a rate of 4,000 DVDs per week. Again, if I divide that by 25, that turns out to be 160 packages per week. And then we have our information about our costs. And so our order costs are $94.50. Our carrying costs is actually the sum of both of these. We have our insurance, care, and handling costs, and then we have our opportunity cost, which this opportunity cost just relates to the opportunity cost of using the money to purchase inventory and hold inventory instead of using the money to earn 15% somewhere else. So your total carrying cost actually turns out to be $41. All right, so the first question related to this information is, what is the economic order quantity? And so again, what we know is demand is in packages annually is 8,320. The order cost is $94.50, and C is the 41. And so again, all you need to do is to get the economic order quantity is take the square root equals, take the square root of 2 times the 8,320 times the 94.50 divided by 41, and you should get an economic order quantity of 196 packages. So every time we order inventory, every time we fill out a purchase order, based on this model and minimizing order and carrying costs, we will order the 196 packages. So it takes some of the decision-making process away and puts it into this scenario. All right, so then we talk about the reorder point. The reorder point is we monitor our inventory, and once our inventory gets down to this point, then we're going to order our next shipment of 196 packages of DVDs. So this problem says, what is the reorder point, assuming we hold 1,000 units in safety stock? I want to stop here for a second. I've given you safety stock, but you should be able to calculate safety stock. Remember, safety stock is the difference between my max reorder point, which is basically my worst case scenario, which means that my maximum reorder point is going to take into effect that lead time could be longer, or that my usage or sales rate could be higher. I don't want to run out of inventory, and so this safety stock says that I am going to look at the longest lead time possible and the highest sales rate possible, and then I'll compare that to my normal reorder point based on my average lead time, my average sales, which is really what I expect, so my average or expected. And if I compare my worst case to my expected, that's going to be the amount of safety stock that I hold. So just be able to calculate what that safety stock is. And so we're holding 1,000 DVDs as safety stock, so that actually turns out to be 40 packages. And so remembering that that's 40 packages. So our lead time is 1 week. We sell 4,000 DVDs or 160 packages a week. And so this 160 is actually 160 times 1. Now, if the lead time were different than 1 week, we would change that. So this is 160 times 1 plus the safety stock, 200 packages. And so we'll watch our inventory. Once our inventory gets down to this 200, we'll order 196 more. All right, the annual relevant costs. My annual relevant costs are my order costs and my carrying costs. So whenever you see relevant costs in the economic order quantity model, the economic order quantity, remember, is minimizing total order and carrying costs. So what I want to do is determine these costs. And so order cost is based on the number of orders. And so the number of orders is based on how many I need, 8,320, divided by how much I order each time, the 196. Then I multiply that times my cost per order and my total ordering cost based on this economic order quantity is 4,011. My carrying cost is based on how much inventory I hold. So my average inventory every time I order is 196. I get down to, in theory, 0 when I receive my next order. And so that's my average inventory, except I have safety stock. I'm always holding 40 in safety stock. So the average of my safety stock is actually just 40. I multiply that times $41 carrying cost per unit or per package, and I get 5,658. And so my total relevant cost here is 9,669. All right, now we're going to look at this EOQ prediction error. And so we determine the economic order quantity at the beginning of the period. And so the economic order quantity we determined is 196 packages. And so notice that when we determined 196 packages, we were estimating what demand would be, what the ordering costs, and what the carrying costs would be. So at the end of the period, if we determine or we find out that one of those parameters was incorrectly estimated or incorrectly predicted, then that would have affected our economic order quantity, and it really hasn't minimized our order and carrying costs. So if we're not really at the minimum ordering and carrying cost, then we can determine what was the actual cost that we incurred, and we can determine the cost of making an incorrect prediction. So here, the only thing that we incorrectly predicted in this problem is the total carrying costs per unit or per package. We thought they were going to be 41. They actually turned out to be 95. So our economic order quantity is going to be not incorrect, but it's going to be wrong based on the estimate that we had. So if our carrying costs are actually higher, then we can kind of think through this. If our carrying costs would have been higher, then our economic order quantity should have been lower because we would have wanted to carry less inventory. And so that our carrying costs are actually going to be more than what we should have had because of the higher carrying cost per unit. But at any rate, the way that we find the economic order quantity prediction error is we look at the costs that we actually incurred, and then we look at the costs that we should have incurred had we correctly predicted the economic order quantity. So our actual costs here are going to be what we actually incurred. And so if you look at what actually happened, we actually used an economic order quantity of 196 packages. Our demand, we correctly predicted at 8,320. Even though that's one of the parameters that could change in this problem, we correctly predicted it. Our ordering costs, we correctly predicted at $94.50. And our carrying costs, we did not predict correctly, and those carrying costs were actually $95 per package. So again, we're looking at the actual costs here. So we determine our ordering costs and our carrying costs based on these parameters, and these the actually things that actually happened. We actually used an economic order quantity of 196, and we actually had all of these other parameters: demand, ordering, and carrying cost. So our ordering cost, again, based on the demand and how much we ordered each time, times the ordering cost per order. And so this is still the 4,011, but our carrying costs, we still had the 196 in, every time we ordered, we received 196 packages. Oops. We also held that safety stock, so we multiply that times now the actual cost that we incurred. We actually incurred a cost of $95. So the $95 times the average inventory that we carried, we actually incurred $13,011 in carrying costs. And so the total ordering and carrying costs of $17,121. Again, our carrying costs are much larger than what we expected. We expected the 5,658, but because we incorrectly predicted the carrying costs, our carrying costs are actually higher. All right, so what we have to do is we have to then compare that. Remember, we have the 17,121 here. We have to compare that to what the cost should have been, and the cost, and what we're doing here is we're determining, well, what economic order quantity, given the fact that we had $95 in carrying costs, what economic order quantity actually does minimize our ordering and carrying costs. So what we have to do is we have to recompute that economic order quantity. So we have 2 times the 8,320 times 9450 divided by the 95. And so what turns out is our economic order quantity really should have been 129 packages. So again, based on what cost should have been, we had an economic order quantity of 129. Demand is still the 8,320. Ordering costs is the 9450. And our carrying cost is the 95. So let's determine what our ordering and our carrying costs are given these parameters. So our ordering cost should have been 8,320 divided by the economic order quantity of 129 times the 9450. And so this total cost, because we make more orders, we would have had more orders under this scenario. Our ordering cost is higher, and then our average inventory, including the safety stock, times 95. Now we hold less inventory since our carrying cost is higher, and so our total carrying cost, 9,928. And notice that that is lower than what we actually incurred. And so the cost that we should have incurred is 16,023. And so if you think about it, I didn't leave myself very much room here, but let's look at the economic order quantity. And so, or the prediction error here. So our prediction error is just the difference between the cost that we actually incurred, the 17,121, and the cost that we should have incurred, 16,023. So our prediction error is 1,098. And this 1,098 is just a reference for anybody who's working with inventory costs and managing those. This is the cost that we incurred over and above what we should have in determining when to order, or actually what to order. And so had we had a different economic order quantity based on a correct prediction, we would have $1,098 less in cost. But again, this is just for information. It doesn't get booked anywhere. All right, questions. Question number 13. Question number 13 is an activity-based costing question, just refreshing your memory on how to go about determining the cost of a job or determining how to apply overhead based on activity-based costing. And so remember back at the beginning of the semester we talked about traditional costing and activity-based costing. Traditional costing typically uses one driver or multiple drivers if we have departments, but traditional costing uses unit level drivers such as direct labor hours, and that's actually what it says they're using now. Activity-based costing uses multiple drivers based on identifying the activities, and so the activities they have identified is maintenance and inspection. And so once you move to activity-based costing, you can use unit level drivers, but you also use non-unit level drivers, which unit level drivers are related to production. Non-unit level drivers do not have to be related to production. So in the case of inspection, the number of inspections is not unit related, because I can pull or do 4 inspections for 1,000 units, or I can do 4 inspections for 10,000 units, and so it doesn't matter how many units I'm producing, and so non-unit levels aren't necessarily related to production. So in activity-based costing, it relieves some of the cost distortions we have under traditional, because now some of those costs are being more accurately applied. And we talked about that at the beginning of the semester. So in activity-based costing, we will have an overhead rate for maintenance and for inspection. We have a total of $50,000 cost in maintenance, which will relate to the 25,000 machine hours. So we actually have a rate of $2 per machine hour there. The 75,000 in total estimated inspection costs is going to be applied based on the fact that we expect a total number of 1,500 inspections, and so that is a rate of, I believe, $50 per inspection. And so activity-based costing takes advantage of the fact that we have identified these activities, and we have 2 different rates. Machine hours, this is thinking about unit level, this is unit level related to production, and this is non-unit level. All right, and then to determine the cost of the job, you add your materials, your labor, and your overhead. And the overhead, again, comes from the fact that we had 500 machine hours and 4 inspections. So the total cost of the job is $3,700. All right, number 14. This is, again, looking at our capital budgeting concepts. And so what we're trying to do here is determine the maximum amount this company would be willing to spend for this printing machine. And again, this type of question can be applied in a lot of different situations. The maximum amount that they'll be willing to spend is the whatever they're going to get in the future, and what they're going to get in the future is this after-tax cash savings of $300,000 for 4 years. So they'll be receiving $300,000 in savings over 4 years, and what they require for their rate of return is 12%. So this is just really determining what's the present value of those future cash flows, and that's the maximum that this company would be willing to spend. And so finding that present value, you're putting in your calculator the payment of $300,000, the number of periods for, and the interest rate that you require to earn is 12%. So you're getting the present value of this annuity, this 4-year annuity. So the maximum you'd be willing to spend on this machine is $911,205. Number 15 is your volume variance, and so this is something that you will you need to consider being able to calculate this, because I think I mentioned after the second midterm that you will see a problem where you have to calculate the volume variance. And so the key here is the volume variance is part of the fixed overhead variance. And so fixed overhead, because these costs are fixed. When I determine this $6 rate, I determine it by taking the total fixed overhead and dividing it by the expected number of, in this case, the expected number of direct labor hours, or direct labor hours here. And so really this $6 rate, the way that I determine it, I am using the 10,000 units of expected production. And so for 10,000 units, I expect to use 2 standard hours per unit. So this $6 rate only applies if I reach a production level of 20,000 direct labor hours. If I produce anything more or less than 20,000 or 10,000 units and use 20,000 direct labor hours, then I will have a variance because the production is different. And this is the production volume variance or volume variance for overhead, for fixed overhead. And so we see that we expected a production level of 10,000. If we exactly hit 10,000 and use 2 standard direct labor hours, we wouldn't have a volume variance, but we actually produced 11,000 units. And so this the volume variance is going to be the difference between our budgeted overhead and what we apply. So our budgeted fixed overhead, we're going to determine that based on the rate that we determined and the number of hours that we actually budgeted. Our applied fixed overhead is going to be based on our fixed overhead rate and how many standard hours allowed we had for our actual production. So we apply fixed overhead in a standard costing system based on standard hours allowed. And so calculating this, we know that our standard rate for fixed overhead is equal to 6. And again, the only time that this $6 is correct is if I have an hour, I apply my fixed overhead based on 20,000 hours, which I know we didn't do. And so our budgeted fixed overhead is budgeted hours times the standard rate for fixed overhead. Our applied fixed overhead is standard hours allowed times the standard rate for fixed overhead. So our budgeted hours is the 10,000 times 2, and our standard hours allowed is the 11,000 in actual production, and we expected 2 hours per unit. And we multiply each of these by 6. So here we had 20,000 hours, and here we have 22,000 hours. So since we applied overhead on more hours than we expected, we will have over-applied overhead, and so I know that this volume variance is favorable. I've over-applied overhead, I've put too much cost into production, so I will have to take the costs back out. And so this actually turns out to be a $12,000 favorable volume variance. Number 16. 16 is, again, using capital budgeting concepts. What we're looking for is determining what that internal rate of return is. I know that my net initial investment is $921,250, so and I know that I'm going to get $250,000 in cash flows for 6 years. And so my internal rate of return is where my net present value equals 0, and my net present value is the present value of that annuity of $250,000 minus the net initial investment of $921,250. And so really the internal rate of return is going to be that rate that makes these equal, right? So I will find the present value of my cash flows. And so the present value of the cash flows has to equal the net initial investment. So the way that I can set this up in my calculator is I say the present value, and actually this is the present value of an annuity. The present value is $921,250, and you either have to put the present value in as negative or the payments in as negative, or your calculator doesn't really like that because they want to know, your calculator wants to know inflows and outflows. So one of these has to be an inflow, one of them has to be an outflow. It's just easy to put the initial investment in or the present value in as a negative. And so I put those in for 6 years, and then I try to solve for I, and your calculator should return a rate of 16%. And so this is a good problem to practice your net present value because really you can use the same information in your calculator. I don't have it down there. You can use the same information in your calculator and try to determine net present value. We'll go back. And so your net present value, and again, if your required rate of return is 14% and your internal rate of return is 16%, then you should actually have a positive net present value. And I don't remember what that number is. I think it's 50,000 something. Just a minute, I'll check. Okay, so that net present value is 50,917. Again, it's a good check to be able to calculate what that net present value is. All right, number 17. Number 17 is your job order costing problem. Again, what you're given here, and you have a situation where you use job order costing and your overhead here in the middle is based on machine hours. So they're using traditional costing. Again, you can have job order costing that uses activity-based costing, similar to what you had on the first midterm, but here we're using traditional costing. They have estimated total overhead to be 840,000 with 16,000 expected hours, so your overhead rate is equal to 52.50 per hour. And so in this situation, job order costing is where I have distinct jobs and I have unique things that I'm making here, and so each job is different. So at the beginning of the July, I had already started jobs 34 and 35, and I'd already incurred 84,000 material, labor, and overhead on job 34, and 53,300 in material, labor, and overhead in job 35. And so during July, I added these costs for materials, labor, and I incurred these machine hours on the jobs. And so this question is asking, what is the cost of goods manufactured for July? Cost of goods manufactured is going to be the cost of all jobs that I've actually completed. And so cost of goods manufactured is job number 34 and 35. So to answer this question, I just need to add the cost of all the costs of jobs 34 and 35, including the cost in beginning, work in process, and applying the overhead. So if you look at where there we have our overhead rate and what cost of goods manufactured is, then you can see here, just by adding up job 34 and 35, and again, this overhead is based on the number of hours they're using times this overhead rate. And so cost of goods manufactured in this case, one too many, is $315.50. Again, just adding up the jobs that were finished. Now, if one of these jobs were sold, let's say, for example, job number 35 was sold, then cost of goods sold would be $112,050. So it's just the cost of that job. Ending work in process would be the cost of jobs 36 and 37. Now, related to this, you should be able to take the information that we have here and determine whether or not manufacturing overhead is over or under applied. And so we have over and under applied overhead because the rate that we use at the beginning of the period, based on the 840 and the 16,000 hours, this rate of 52.50 is an estimate. And so more likely than not, we will not have 840,000 in total overhead or use 16,000 hours. So we will have applied overhead throughout the year on a rate that was actually different. But we don't know the actual rate until the end of the period. But applying overhead, we have to estimate, and because of that estimate, at the end of the period, we could be off in our total estimate, and so we determine what over or under applied overhead is. So over applied or under applied overhead, I'm going to compare actual overhead to applied overhead. My actual overhead is incurred is outlined here in these three numbers. My applied overhead is going to be based on how much overhead I applied in July, so I'm going to add up these machine hours and multiply it times my overhead rate. So here you see actual overhead is $238,500. Applied overhead, again adding up those machine hours, multiplying times my overhead rate, and you can see here that applied overhead is less than actual overhead, so I have underapplied manufacturing overhead. Question number 18. Question number 18 is another process costing problem where I give you the fact that you have 1,000 units in beginning inventory. We started and completed another 8,000 units, and what you're looking at here is what is the total cost of goods transferred out, and we'd be using FIFO. So I've transferred out a total of 9,000 units, and so I have to determine the cost of those 9,000 units. And so really, if the cost is those units in beginning work in process, so under FIFO, I have two components. These units in beginning work in process. I have the costs that were already in beginning work in process, the 21,000, which represents the cost of all the materials and 60% of the labor and overhead, so 60% of the conversion cost. But I have cost to finish those units. So I need to know what it's required to finish those units. So if you look at your equivalent units for materials and conversion for those beginning work in process units, if all my materials have been added under FIFO, I don't have any more, none of the units, those 10,000 units, 1,000 units will be have materials added this period. But for conversion, I'm 60% complete, which means that I have 40% remaining on those 1,000 units. Then I have started and completed of 8,000 for each of those. So to finish the units in beginning work in process, I'm going to take the 400 times my conversion cost. My conversion cost, total conversion cost per equivalent unit is 24. So I add 9,600. This is the total cost of those 1,000 units. And then started and completed, I have 8,000 units, and I can multiply that times the $6 plus the 24. I can multiply that times the 30, and you get 240,000. And so I have a total cost of goods transferred out of 270,600. Now, if I had any type of spoilage, which this question does not have, but if I had any type of spoilage, what would be included in here would be the cost of the normal spoilage. So don't forget that normal spoilage is part of the cost of goods transferred out. But I don't have spoilage in this problem, but be aware that that could be a case. All right, question number 19. This is just looking for payback. And so in this question, I give you these before tax and depreciation cash flows. So really what you have to do here is just calculate what these after-tax cash flows are. So you're going to subtract depreciation on all of these, and then take this times 1 minus the tax rate, or determine what the after-tax is, and then add back depreciation to get your cash flows. Or I could take this times 0.6 and add the depreciation times 0.4. So what this does is you have your after-tax cash flow, and you adding the tax savings from the depreciation. Either way you want to do it is fine. The only reason I say this is because this is how it's presented on the next slide. So really it doesn't matter. You can take the 20,000, subtract the depreciation, get your before tax net income, multiply by the tax rate, and get after tax net income. And then add back depreciation like you've done before. That's a little messy, but I think you get it. All right, so here are your cash flows. Again, you should have gotten the same cash flows whether you did it the way that I did it, with the after-tax plus the depreciation savings, and remembering that you have, well, these come from the maker's table. The maker's table will be given on the exam, by the way. I don't think I mentioned that. So there's your cash flows, and then you're just looking at how long it takes to recover the $50,000, and it looks like by the end of year 4, you have $248 left to recover. How far into year 5 do I have to go? I look at the cash flows that I'm earning in year 5, and this is the portion of the year that into year 5 that I have to go. So it's 4.05 years. All right, number 20. Number 20 is a backwards variance problem, and so typically in these, again, I read the problem and I determine which variances I'm looking at, and so then I can start to draw my diagram and put in everything that I do know, and try to get back to what I don't know so that I can actually solve the problem. So here I have materials, so I'm working with material variances. I have a quantity, or this is also usage, material usage variance of 3,000 favorable and the price variance of 5,000 unfavorable. And here I know that they purchased 50,000 of direct material, gallons of direct material, all of which were used in production. So that's important, because what I can do here now is I can say actual quantity times actual price compared to actual quantity times standard price. That's going to be my price variance. But since the actual quantity purchased and actual quantity used are the same, then I'm going to use the same predicted number in determining my usage variance. So standard quantity allowed times standard price. So now I start putting in everything I do know. I know that my usage variance is 3,000 favorable. I know my price variance is 5,000 unfavorable. I know that the actual quantity that I purchased and used is 50,000. And I know my standard quantity allowed because I produced 11,000 units of product, and I have a standard number of gallons of 5 gallons per unit that I produced, so my standard quantity allowed is 55,000. So what I can do is I can concentrate on this usage variance, because the only thing I don't know the difference between these two is the standard price. So I can take 55,000 times the standard price minus 50,000. I do this because I know this is favorable. So I know that the predicted amount is less, times standard price equals 3,000. Ran out of room. But if I solve that, right, if I solve that, my standard price turns out to be 60 cents. And so I can put the 60 cents here, and now I know that the predicted amount is 30,000, and since this is an unfavorable price variance, I know that the actual quantity, or the actual amount that I paid for those gallons, is 35,000, so then I can divide that by 50,000, and I get 70 cents as my actual price. Now, if the amount of quantity purchased is different than the amount used, you can still use the structure, but you have to say actual quantity purchased times standard price, actual quantity purchased times standard price. This would be your price variance. Now my predicted amount is going to be different. If the amount used is different, then I say actual quantity used times standard price compared to standard quantity allowed times standard price. That would be my quantity or usage variance. So you can still use the structure, just be aware that these two amounts could be the same or they could be different. All right, that is the review assignment. I do want to make you aware that I have put another practice problem up here, determining cost of goods manufactured in the case where I just give you balances and materials and things like that. And so practice getting cost of goods manufactured with this type of information. Again, this is a problem that we did towards the beginning of the semester. Knowing that you have to determine direct materials used, using the direct materials used in cost of goods manufactured, which is materials, labor, and overhead, plus beginning work in process minus ending work in process gives you cost of goods manufactured. Again, most of the time we did this with T accounts, but that's up to you. All right, good luck, and let me know if you have questions, and I will see you during the final exam.